Hi, everyone. This is Jason Burack of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast. Today, instead of a normal interview, what John Manfreda and Dawoud and I are going to do is have a discussion about why we see higher oil prices and higher gasoline prices in the U.S. and in other countries where there's not a large subsidy. And then we'll talk about some of the sectors then where in the oil patch where we see value. We're not going to name any specific company names really. And then, maybe we'll talk about some other solutions there for people then and what they could do about gas prices, in terms of switching, to a better, more fuel-efficient car or carpooling or things like that, besides just investing. So without further ado, let's get the ball rolling here with a discussion on some of the fundamental reasons why we see higher oil and higher gasoline prices in the next 18 to 24 months and probably longer than that.
Well, a lot of people are blaming higher gas price on, the politicians are blaming the speculators and the evil, big oil companies for raising the prices. And we got people on Main Street blaming, the same people, the speculators and the evil big oil companies that, raising the gas price for no reason, just to make more money. But that's not true at all. I mean, one of the reasons why oil prices is going up is the supply and demand fundamentals. I mean,
let's dig into that in depth a little bit more, Mo, about the, you mentioned the supply-demand fundamentals, and that's very vague for most of our listeners. So let's talk about the overall supply-demand fundamentals for the oil market. Now, on the supply side, you can tell me, you guys can step in at any time if you disagree or you want to add to points. But what I see on the supply side is a lot of the major oil fields, the Cantarell in Mexico, Iran, Iraq, the Ghawar in Saudi Arabia, and some of these other larger major fields where these guys have been, OPEC net exporters of oil for many decades, and their production rates, their flow rates are declining pretty rapidly.
Yeah, that's true. Not only that, there's the refining capacity. Right now, what people don't realize is over the past 2 weeks, oil has been trading flat. It had a high of 110 with the Saudi pipeline explosion rumor. But if you looked at I think it's the crack spread ratio, it's gone up recently, but a lot of gas stations and fueling stations were losing money because the refined products were unprofitable at the price of oil. So a lot of these refined products, they had to go up in price. And our refineries are shutting down, so there's actually less gasoline on the market.
And exactly, John, and that would add, and the Saudis, the lack of spare capacity from the Saudis and the Russians, if I could add that too. There's just not really any real spare capacity. I mean, the Saudis do have, I think what they added, 700,000 barrels per day or something like that of heavy sour crude, but that oil is not able to be refined all over the world in every single refinery. So it's not going to help out as much as everyone thinks it will. On the demand side, guys, let's talk about some of the discrepancies here because, the politicians here in the United States, a lot of them are saying, but how can oil and gasoline prices go up and with the American demand for gasoline dropping? So can you guys talk about some of the reasons why, the oil market is a global market and why demand is not dropping globally, why, even if it can drop here in the United States a little bit, and demand has been dropping here in the United States for a number of years, especially since oil spiked to 147 a barrel. But talk about the demand and how demand is outpacing supply globally.
Well, people need to realize first that globally, the non-Western countries are starting to consume more oil than the American. And I saw an interesting statistic online that indicates that by 2020, 1 billion barrel of oil per day will be needed in the non-Western world just to keep up with the demand. So the demand in the non-Western world is increasing while the demand here in America is stable. And there's just not enough supply out there in this world to keep up with this demand. I mean, no one's finding an oil discovery with billion and gazillion gallons of oil in it. So the reserve, this goes into peak oil. So the supply for cheap oil is peaking and going down in production.
Well, that's true. And another thing is, because of the lack of big discoveries, oil companies have to spend an enormous amount of more, and they're finding less and less. So now what some oil companies are doing, Exxon did this with XTO Energy, instead of breaking the bank on the exploratory budget, they're now just buying proven reserves of smaller oil companies during down cycles. That's what Exxon did with XTO Energy. And you're seeing more and more of that. Some of the Seven Sisters are even starting to merge, so they have more reserves on their books. So that's another thing that's happening with the supply side, is the exploration is becoming much more costly and more expensive.
And to add to the cost there's also the extra, environmental rules and regulations here in the United States and some of these other more Western European types of countries. But in terms of, these larger oil companies, John, and you're more of our energy guy, you spend more of your time looking at energy than necessarily gold and silver stocks. Could you talk about the transition you see from these larger oil companies? It seems to me that they're transitioning away from being predominantly just oil companies, and that because oil, is controlled by so many national oil companies, and a lot of these larger discoveries, if there are ones like in Brazil and other areas, the governments could go after the oil, like in Nigeria or other places. So talk about the transition that these larger oil companies are doing. Maybe they're transitioning to natural gas, or they're transitioning to renewables, or things like that.
Yeah, they are definitely transitioning. One, because of taxes. They always say one of the things oil companies did a while back is they're now called energy companies. And one of the main reasons they did that was to avoid taxes. They were scared of windfall profits taxes. You could even go back, you can hear not just Democrat senators, but even Republican senators in 06 or in 07 talking about windfall profit taxing them. So to avoid that, they became energy companies. And not only that, because the exploration costs are so high and the reward, it's not like the exploratory rewards you got back in the 50s and 40s. You're getting small, heavier, sour crude, a lot of the unknown oils in the deep water, and that's very expensive and very risky. So you see Chevron, I know they're investing in geothermal. A lot of wildcatters are becoming geothermal wildcatters because it's just cheaper to explore for that. You see Exxon, they're doing algae oil because it will be a lot easier to refine and process that in the future than it will be. Texas has over 300,000 wells of oil, and those oil reserves aren't economical at $140 a barrel oil. That ought to tell you something about the costs of drilling oil that are going to rise in the future. They're rising now, actually. So a good amount have natural gas, too. A huge amount. Exxon bought XTO Energy. BP is even investing in biodiesel fuels. So a lot of the Seven Sisters are going into alternative fuels as well, whether it's natural gas or algae or biodiesel.
And those are great points, John. And I think it's because their hand is being forced, not just by the market and free market forces, but also by governments, because oil is not a free market commodity. The oil market is very, the best word to say is politically controlled, because as you guys mentioned a little bit earlier in the interview, there's the subsidies for some of these OPEC exporters that they subsidize the consumption of some of their own citizens' production. They subsidize the consumption, so some more of their production is consumed by their own economies. And, if you are a citizen in Saudi Arabia or someone in China, and you can go out and get oil for 30 cents a gallon, and you're not paying a free market price, there's no demand destruction when oil goes to 130, 140, 150 a barrel, and that doesn't translate to you at the pump to prevent you from using the resource less efficiently. So I think this is a lot of the problems here with what we have going on. I think we're going to talk about each factor a little bit more specifically here now. We're going to go down the list of factors here why we see higher oil and higher gasoline prices, and we think we see a new normal here in the United States where the majority of the country is going to see at least $4 a gallon oil in the next 12 to 18 months, and that's not going to be a high, guys. I think that's going to be the new normal. I think that's going to be the price floor.
And that's going to be pretty unfortunate for people on Main Street, because that's going to hurt their discretionary spending. It's going to hurt their purchasing power, because they're going to have to pay more for food and energy now. I don't think people understand the consequences of higher oil prices. It affects a lot of sectors in the economy: agriculture, retail, automobile. So I don't think people understand the implication of this. And, you know, people are pretty ignorant when it comes to why we have higher oil prices. I mean, we hear people blaming the speculators and the big oil company for being greedy, but I think people need to start blaming the government attitude toward the oil companies, because they're the ones that are taxing them at higher rates. I mean, the state and federal taxes for big oil companies is 39 cents per gallon average. The refineries only take 26 cents per gallon. So the government is taking more of the oil profit compared to the refineries. So I think the attitude the government have toward the big oil company is hurting the oil price as well.
Yeah, and one other thing I wanted to add is also another reason that oil prices are really high is because this has been done since the 50s, is because of government intervention. Technology innovation is horrible. You know, people talk about new technology and hydrofracturing, which, yeah, it does have its flaws, but I wasn't going to bring those up. What I wanted to make point is that's new technology. It was created, though, in the 50s. You know, it's not really new compared to, if you look at other sectors like the technology sector, the internet, and other just sectors of the economy, it's actually in a lot of other sectors that would be considered old. But in the energy sector, because a lot of companies are state-owned overseas, there's huge interventions. In the 50s, oil companies were only allowed to produce oil 8 times a month. How much innovation can you get when you're only allowed to do 8 times a month? And then in the 70s, when prices went high and investment was finally being made, they passed a windfall profits tax. That killed off technological innovations when it comes to drilling and extracting. And there's been hardly a lack of technology due to government. A lot of these oil, I'm not saying they'd be cheap oil, but they wouldn't be as expensive if government just left them alone and let them innovate.
And those are all great points, guys. And I think a big point here that we're trying to make is that we're not running out of oil, period. There's plenty of oil. And this goes into, peak oil theory. We're not running out of oil, like I said. This is just peak cheap oil. Okay? So a lot of the light sweet crude, the stuff that's easiest to find, easiest to produce, that we would spend 1 barrel of energy to find 20, 30, up to 100 barrels of oil, all that easy oil for the most part with a really low production cost, easier to find, et cetera, is gone. And if there is oil that's like that, it's either, under 5,000 feet of ocean and then under rock in Brazil, which means the production cost is not going to be $10 a barrel, or it could be, controlled in a very geopolitically unstable area, like, say, perhaps, Nigeria or in Iraq, which still has a good amount of oil left, which had an underinvestment of in its oil reserves, Iran and other areas. Would you say that's correct?
Oh, yeah, I agree. Peak oil is another fundamental reason behind the increase in oil prices. And again, like you said, peak oil does not mean we're running out of oil, we're just running out of the cheap oil, which is, the oil where we poke a hole in the ground and the oil just starts spurting out, which is just the cheap stuff that we are used to for the past half century, or over a century, I guess. And now we're forced to go offshore to drill, for deep shore oil, deep underwater oil that costs a lot of money to pull out and will cause the oil prices to go up. So yes, I agree that peak oil is one of the other fundamental reasons for higher oil prices.
Yeah, I would say definitely that. And not only that, it's just there's never been investments in any other type of liquid fuels. Oil's been, it seems like the sole liquid fuel for centuries. Or not centuries, for decades. And so
over 120 years.
Yeah, so right now, you know, we're not close to completely. Like, people talk about they want to transition out of petroleum products. The thing is, you need a bridge gap. You can't just go overnight. You can't go overnight. It's sort of like losing 100 pounds. If someone's really, really obese, they're not gonna lose all that weight overnight. It has to transition.
And it's physically dangerous to lose that much weight that quickly, right?
Yeah, that's what I believe. I'm not a health scientist or anything, but that's what I think so. So there needs to be a bridge gap, and there needs pipeline infrastructure, refining capacity. A lot of refineries are being shut down because they can't refine the heavy sour tar sand stuff. And that's going to create gasoline shortages. So there needs pipeline. Like California, they have to import more petroleum or more oil from the Persian Gulf. And then they complain about being on foreign oil, yet they're close to the Bakken and they're against building pipelines from the Bakken so they can use that oil.
Exactly, John. And I think a lot of the stuff you gentlemen have just described in detail in the last 15 minutes talks about a rough transition ahead, because the majority of pretty much the entire U.S. economy is built on the assumption that oil will always be cheap and plentiful, and that, you know, the oil price was going to be under $1 or $2 a gallon at the pump. And, you know, we have to, especially in California and other types of states, you have to drive a lot of distance to go to places. There's not a lot of easy public transportation, and you know, this is not things have not been planned out 20 or 30 years in advance to make those transition periods easier. Now, I know there was supposed to be transition plans put in place, I believe, in the 70s, but what happened instead was all that extra Saudi production was brought online, and what we did was, you know, the petrodollar system, and that bought us some time. So I think we're almost out of time here. It's going to take at least, you know, 15 or 20 years for our economy to transition. Like right now, the world supply chain is just-in-time inventory. For our listeners out there who are not familiar, what that means then is that for goods to be made, and 95% of all goods are made with oil as an energy input cost, so those are inflationary. That means a higher production cost. But the just-in-time supply inventory, though, is, you know, goods are partially made in one area of the world, so China, and then, you know, they're shipped to Vietnam or another area of the world like Mexico, and then they're assembled partially there and then sent back to China and then fully assembled and shipped back to the U.S. to be sold. So can you guys address what you think is going to happen then with the just-in-time supply inventory chain on the assumption that oil does go a lot higher?
Well, I think what's going to happen is you're going to see, you know, companies like Apple or all the other companies that rely on overseas manufacturing to create their product is to start bringing them back within their borders and start producing them within their own country. And it will be a little bit more expensive, won't be more efficient than the way it is in China, but I mean, what other choice do they have if oil prices keep going up? So when Apple start, you know, putting out those iPads and those iPhones, I mean, those prices are going to go up when the oil prices go up. So they have no choice but to bring those jobs back within their borders just to protect whatever profit margin they can.
Yeah, and that's going to take some time, though, on the transition. And the transition is not going to be, you know, beneficial for China either, because here China has all these manufacturing jobs, assembling/manufacturing jobs where they assemble the final piece of the good. They're not, providing all the value-added parts necessarily. But I don't think China is willingly going to give this up either. Maybe then the Chinese government would subsidize the goods then for the manufacturers to stay in China. Then we might see something like that occur. So this is all, we don't know exactly how the governments are going to react. But I think it's very important for our listeners out there to understand that these subsidies are going to distort the market further, and they're going to, force a lot of incorrect malinvestments and, incorrect price signals here with some of the market distortions there because of the lack of free market forces in the prices. That would create the demand destruction, that would force people to use the resource more efficiently, that would force at $150, $200 per gallon per barrel oil to move all of their manufacturing bases if they were a U.S. company back to the United States. So in the last 10 minutes or so here, guys, of this podcast, let's take the time for our listeners to line out all of the supply-demand things bullet by bullet. So let's go down here, a list of things here. Number one, guys, I think one of the major factors driving a higher oil price is the devalued U.S. dollar, because all commodities are priced in dollars, and because the dollar is still the petrodollar and the world's reserve currency. What do you guys think about that?
I agree.
I would say, yeah, definitely.
Go ahead, John. You have something to add?
Oh, yeah, I would say definitely. Right now, Wall Street's so short-term that they don't see hardly any of this coming. A lot of the world's oil, and not only that, because it's state-owned, there's a lack of technology in it. The best example is in China. They have 200, supposedly they have 200 years, I don't know how many years, but 200 years worth of shale gas.
Shale?
Shale, yeah. To underneath their reserves, but they don't have the technology to get it into the market or even to crack it out of the rock. So they're going to have to invite a lot of foreign investment into their country to get that technology.
Okay, so we see a tremendous underinvestment then by a lot of these OPEC countries too, where a lot of their oil profits over the X number of decades, especially like Mexico, where they have not reinvested any of the profits from their national oil companies back into expanding oil production, expanding oil reserves, et cetera, where their politicians have decided to spend all of that money on social programs, and they haven't run their business prudently. And this goes back to, why we are free market proponents, that if this was an oil company, right, they would be managing their reserves and looking to grow production, et cetera, and reinvesting in the business so the business doesn't die more astutely.
And I agree. And if you also, in relation to the devalued dollar and how that affects the oil prices, if you could value the price of oil in gold and silver, it's actually a lot cheaper to buy oil with those two metals than to buy it with the dollar.
Yeah, exactly, Mo. And the thing is, and this exemplifies a lot of the problems, period, with paper fiat money, is that over the last 10 years, for the most part, oil has gone higher faster than gold for a certain amount of times, but over that total span, especially now, oil has never been cheaper in gold and silver terms. And yet it's never been more expensive in paper fiat currency terms. So I think this shows the dislocation here and the problem with our money, that it just doesn't store value.
Yes, I agree. Another thing that the government doing that's hurting the oil prices is the fiscal and monetary stimulus that's being applied to the economy. It increases the price of oil, but it doesn't increase it in the same way that, the stimulus would increase the price of gold and silver exactly. If you guys are familiar with the petro business cycle, am I correct?
Yeah, exactly. And a higher oil price, guys, is going to create boom-bust cycles. Like, look when oil spiked to 147 a barrel, only like 2.5 years ago or so. And that basically, besides all of the other bank failures and stuff, that helped trigger a market crash and, a recession/depression. is our economy. I don't think our economy is equipped to deal with oil prices staying that high on a permanent basis. I don't think it's adapting well enough to do that right now.
Yeah, the lack of substitution for oil is hurting our economy. I mean, there is alternative energy, but it's not producing at a mass scale, and it's not economical enough to completely replace crude oil as well.
Yeah, and it's sort of the U.S. is in a huge trap because, they can't have high oil prices, but supplies is dwindling. But in order to get more supplies so they can actually do their day-to-day activities, oil prices need to rise. So it's sort of stuck in, pick your poison pill, if you ask me. And with the devaluation of the currency, you can't eat without oil because you need oil to farm, to have all these water, like to water all the amount of food. You can't do it without the oil and the petrochemicals. So
exactly, and the petrochemicals for fertilizers and stuff, which create the crop outputs, which create the yields, so we can feed 7+ billion people. And this is what's turning what I would call, into a vicious cycle, because the cheaper oil is, the more basically that people can divide up labor, that people don't have to spend all of their time, growing food and doing all of these other rudimentary type of things that our ancestors had to do a long time ago just to survive. And this allows for the population to grow. So, and as the population grows, especially with subsidized oil prices, that creates, a more of a feedback loop and a larger demand for oil. And yet supply is not keeping pace globally with demand.
And I believe for the next 20 years, the population is expected to grow at least 1.4 billion. It grew in the last 20 years 1.6 billion. So we're still seeing a huge population growth on this earth, and there's just not enough oil to keep up with that demand. As we said numerous times in this discussion.
Well, Mo, I don't think it's a question of oil reserves, because I think there's plenty of oil that, like Venezuela and these other guys have. It's a question of production and flow rates.
I agree.
Because a lot of these other wells, the older wells, the production and flow rates, even with fracking and some of these other things that they can, saltwater injections and these other techniques to carbon dioxide injections to reinstitute the wells and get a little bit more production out of them, it's not keeping pace with global demand increases. And I think a lot of the global demand increases is because of the subsidy. Would you guys agree with that?
Oh, I agree.
Oh, I agree 100%. There's no, you don't see, in the emerging markets, you don't see any type of consumption slowdown during higher prices. And the only reason is subsidies. So there's got to be, I don't know what any other explanation would be. They're not producing that much where they can just keep consuming the same amount of oil. So
exactly. And a lot of these OPEC countries then, guys, if these subsidies continue, if demand in these countries like Saudi Arabia, like Iran, Iraq, and we saw this in Indonesia. Indonesia used to be a member of OPEC, I think, a few years ago. And they used to be a net exporter of oil, and now they're a net importer of oil. So do you guys see this as a realistic possibility that in the next 10 years, a lot of the current net exporters of oil, because of their policies where they're not reinvesting any profits into, or the right amount of profits into expanding reserves and oil production, and they're not giving their citizens a free market price, I personally think that some of these OPEC countries are going to become net importers of oil, which is a sobering thought.
Oh, yeah, I agree. I mean, don't be surprised if Iraq or Saudi Arabia or Libya or any of those oil-producing countries start importing oil because the amount of cheap oil they produce is declining. China is already importing a lot of oil. They took advantage of the lower oil prices in 2008 and bought a lot of oil and a lot of other natural resources as well. So a lot of the oil is going to China and India as well.
Yeah, that was very savvy of China. When the oil price, the paper oil price, dropped to I think 35 or 30, somewhere around there a barrel, China locked in very large long-term supply contracts with Brazil, Petrobras, and with Russia, who are two of the larger, faster-growing producers. I think Russia's the largest oil producer in the world now, ahead of Saudi Arabia. And they paid well above the paper price to lock in a long-term supply contract for oil.
Yeah, and another thing, too, is with the oil, Venezuela has a huge amount of oil, but it's all tar and heavy sands oil, and one of the reasons they sell to the U.S. so much, even though Chavez hates the U.S., is because our Gulf Coast refineries are the only ones that could refine this heavy tar sands oil, or heavy sour crude. And so the sad thing is the U.S. refineries are really in bad shape, shutting down. What refineries have to do is they buy oil on the open market, and then they refine it, but they sell it not based on oil price, but based on the petroleum products like gasoline, heating oil, and everything.
Plastics and stuff, and fertilizers, right?
Yes.
And asphalt.
So refineries have been shutting down because of not just the petroleum products, but it's a lot harder for refineries to hedge because when they sell the finished product, they don't know what that price is going to be. And volatility, which we have because there is a good amount of paper oil. It's not like gold and silver, but there's still a good amount. Volatility hurts the refineries the most.
Because these are all interesting points, guys. And do you guys have any more thoughts to add on some of the supply-demand fundamentals for oil and why we see, a higher price going forward before we wrap things up here?
Okay, to sum up the discussion that we had today, I think it's important for people to realize that I think the government should share some of the blame for the higher oil prices. I mean, they're the one that are trying to control a majority of the oil reserve and production around the world. They're the ones that are, providing subsidies for these oil prices and gas prices. They're the ones that are, trying to put in higher taxes for these big oil companies and, accusing them of being greedy by raising the oil prices. And, it's not fair to completely blame it on the big oil and the oil speculators as well, because I think the government should take a big blame for the higher oil prices. Do you agree?
Yeah, I agree. They're the ones running up deficits and printing money, too, not the oil companies. And not only that, people forget the largest production companies are all state-owned. It is anything far from a free market. The Seven Sisters don't have the influence that they used to have. I think the largest companies, 16 or 17 largest companies are all state-owned, so it's not a free market at all. And the government prevented a lot of the technology from being formed, which would make costs go down and more reserves profitable.
Yeah, and it's unfortunate that people on Main Street don't take the time to actually dig in to see why oil prices is actually going up. And, it tells you how misinformed these people are. And, they only rely on whatever they hear on mainstream media. And you can see people like Bill O'Reilly, accusing big oil companies for driving up the prices because they're being greedy. But that's not the case at all. So I want to transition to our final topic of this discussion, and that is how investors can take advantage of higher oil prices. And John, you've been investing in this sector for a long time, so what are some tips and advice people should do to invest in oil?
Easy. I would say in this macro environment, the two best, most profitable ways are if you want capital gains, I would say it's going to be through the junior producers and the service sectors. Here's the reasons why. For the juniors, as I said earlier in this interview, in order to increase reserves, a lot of the Seven Sisters are big oil. They have to break the bank in the exploration budget to find minimal amounts of oil. So it's a lot easier to buy a good oil junior that has good amount of reserves than it is to, drill a dry gas hole or explore and have nothing, wildcat and have nothing come. So the juniors will get bid up, and every time even if there is a downturn, a lot of them come in and buy oil reserves with good oil companies, oil juniors with good reserves. And another one is because it's been so state-owned and the technology is so lacking so much, and because we're running out of the light sweet crude, the oil service sectors are going to get huge contracts. I would say one example is China. They have 200 years, supposedly 200, I don't know exactly how many, could be a little more, a little less, of shale gas. And they don't have the technology to bring it onto the market. That's why natural gas in China is so much more expensive than it is in the U.S. So they're going to have to be very friendly to foreign investment in order to get that shale gas. So the service sectors would be very profitable. Same thing with Saudi Arabia just gave a contract to some companies to start cracking more oil because they're opening up oil fields they haven't been touched for 30 years. So the service sectors are going to start getting numerous amounts of contracts because of the exploration that needs to be done and the type of drilling that needs to be done. So I would say the drilling and the service sectors. And if you want yields, I would say the safest are the pipeline companies. You don't have the drilling risk, or the once it goes, it flow. Once it's sent, it flows. You don't have to worry about an oil spill or bad drilling or difficult to refine oil. It's already refined and it's being transported. I think the transporters, which are the pipelines and MLPs, will do well. And if you really want yields, the energy trusts, which are production companies, but they pay out 8 to 10% dividends once a month, and they're very well run and efficient companies.
Oh, I agree. And if people are looking for growth in the oil sector, the junior oil stock is the best way to go. Now, people should be careful and do prudent due diligence on these companies and look at, the geographic location of these wells. I mean, a lot of these light sweet crude oil, as we mentioned earlier in the discussion, are in geographically controlled areas that are run by the government, like Nigeria and Iraq and Libya and all the other countries. So if investors want to invest in those junior oil stocks, it's better to diversify their holdings so that if one country decides to take over the oil production, it won't hurt your portfolio that much. So that's one tip I give to people that are trying to look for junior oil stocks. I also like to look at junior that have light sweet, because those are the ones that are more rare, and those are the ones that, most likely to be bought out by the big oil companies like Chevron and Exxon, because those light crude oil are in higher demand, and it's easier to refine, and it's more rare, as I mentioned before. Now, depending on your investment strategy and your risk tolerance, if you don't want to take too much risk, then those MLPs and the Canadian Oil Trust Fund that you mentioned, John, are the best way to go. They provide constant cash flow into your portfolio with the dividend yields, and it's less riskier than holding those junior oil stocks as well. And you can hold the big oil stock too, like Hess and Chevron and all the other companies. Nothing wrong with those companies. They provide a decent dividend yield as well. So I think that's what people should do, in my opinion, when they invest in the oil sector. Do you agree, John?
Oh, yeah, and another reason I would say oil stocks should be must in portfolios is because if oil outperforms the price of metals, which there's no guarantee it will, I'm very bullish on the metals too, but it's possible. I'm not saying it's definitely going to happen. The gold is normally the hedge against currencies debasing, but just in case it does and the energy crisis is looked upon and gets bidded up, the miners can get hurt. So that way, if that does default happened in 12 or 2013, your portfolio will still be up because you hedged with some oil stocks.
Good point, John. And just to summarize our whole discussion for tonight, there are many factors behind rising oil and gas prices. One of them is the supply and demand. The global demand for oil is going up, and yet the supply is having a hard time keeping up, mainly because we're running out of cheap oil, which is what we've been talking about in this discussion. Peak oil. The production for light crude oil is going down. Does not mean we're running out of oil in this earth. It's just that companies are now forced to go offshore and drill deep down in the deep ocean to get oil from this earth, and it costs a lot more to pull them out, and production cost is higher, so that equates to higher oil price. The other reason is the government. The government is responsible for this because of their monetary and fiscal stimulus that devalues the dollar. It decreased our purchasing power, so we have to pay more for energy costs. And in effect, that also increased the food costs because a lot of the food that we import from around the world is imported using oil. So it affects agriculture, the retail, automobile, and other sectors throughout the economy. And John, do you want to butt in here and discuss all the other reasons why oil prices are going up, like the refineries?
Yeah, it's going up. Well, the biggest reason with gas prices is, the sad thing is I was talking earlier how bad the refineries are, but we have the best ones in the world. So, the world's ability to refine oil is really bad. The Gulf Coast is the only one that can refine the heavy sour stuff in the world, actually. And the pipeline transportation is really pathetic. We turned down the Keystone XL pipeline, and so Canada has a hard time getting their tar sands into the market. Eventually it will have to be approved. Right now they're working on a northern pipeline towards China, but China doesn't have the technology to crack their own shale gas, much less refine heavy tar sand. So I think it will have to be the Keystone XL pipeline will have to be approved. And the refineries are another reason. So as oil goes up, because of the production and the production cost and everything, and the refineries, they get hit the hardest with volatility because they're unable to hedge everything because their retail gasoline has to be sold on the open market. And so not all oil can be hedged. And the price of, the finished petroleum product is easy to predict. So...
Great point. And we're not going to discuss any specific companies or oil stocks, but the good news is that we're coming out with an oil report in a few weeks. So if you're interested in seeing what companies that we like, stand by and look out for our oil report that's going to be out in a few weeks. If people want to prepare and find other ways to prepare how to deal with the energy crisis that could potentially come in the near future, you could also check out Dr. Chris Martinson's website. He provides great information on how to prepare, and he also provides great educational information on why this is happening as well. So I recommend people to check out his website. That's all we have for tonight. Until next time, we hope you guys have a great week. And if you want to check out more of our podcast, go to www.wallstreetformainstreet.com. We also have articles on that site as well. So until next time, good night.